Why should you invest in S&P 500 right now? Warren Buffett's advice. Hey guys, today we're going to talk about why should you invest in S&P 500 right now? Warren Buffett's advice. Let's get right into it. November has arrived. The stock market is the scariest thing around. Not a haunted house or trick-or-treaters. Many investors are concerned. This year has seen their portfolios sink like a brick. In recent days, several of the largest corporations reported disappointing quarterly results. Some argue that it is better to buy stocks sooner rather than later. Others believe that the worst is yet to come, especially with a potential recession on the horizon. Should you invest in stocks right now? Here's some advice from Warren Buffett. In his 1986 letter to Berkshire Hathaway shareholders, Buffett stated that he tries to be fearful when others are greedy and greedy when others are fearful. He strongly advises against letting the current bear market scare you away from investing. One key reason for Buffett's opinion is that bear markets provide excellent opportunities to purchase stocks at low prices. In 2018, he stated in an interview with CNBC, "The best chance to deploy capital is when things are down." The iconic investor wrote in his 2008 letter to Berkshire shareholders, "Whether we're talking about stocks or stocks, I like buying quality merchandise when it is marked down." You might be tempted though to wait to try to buy stocks at even lower prices than you can get now. Buffett would almost certainly push back against that approach. In a speech he gave at Columbia University in 2009, he said, "Don't pass up something that's attractive today because you think you will find something better tomorrow." It's also prudent to heed Buffett's warning about clinging to cash. He once stated, "Today, people who hold cash equivalents feel comfortable. They shouldn't. They have opted for a terrible long-term asset, one that pays virtually nothing and is certain to depreciate in value." Those are especially applicable words in today's high-inflation environment. Buffett may advise you not to buy individual stocks depending on your background and motivation. He could instead suggest an S&P 500 index fund, such as the SPDR S&P 500 ETF Trust or the Vanguard 500 Index Fund ETF. In Berkshire Hathaway's 2020 shareholder meeting, Buffett stated, "In my view, for most people, the best thing to do is owning the S&P 500 Index Fund. What advice do you have for investors willing to put in time and effort to research individual stocks?" Buffett would most likely emphasize the importance of focusing on the business rather than the stock. In his 2021 letter to Berkshire shareholders, Buffett wrote that he and his longtime business partner Charlie Munger are not stock pickers, we are business pickers. The legendary investor is a firm believer in assessing a firm's competitive advantages. He stated in the past, "The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage." Of course, Buffett also thinks valuations are important. He once said, "For the investor, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments." Buffett certainly lives what he preaches. He has not been deterred by the bear market. During this year's market downturn, the multi-billionaire has led Berkshire to purchase a number of stocks. Berkshire Hathaway and Occidental Petroleum are two stocks he's almost certainly going to keep buying in Q4. Both of these companies represent industries that Buffett is well versed in. He is aware of their competitive advantages. He is content with their valuations. It's safe to say that Buffett would not advise investors to mimic his every move. Of course, he wouldn't mind if more people bought Berkshire shares. Buffett, on the other hand, would likely advise individual stock investors to follow his lead and focus on owning well-run businesses at attractive prices. And he'd perhaps add something he said before: if a business does well, the stock eventually follows. So, how is the S&P 500 doing now? The market could still easily fall before rising again. According to data from mutual fund company Hartford Funds, the average bear market drags the S&P 500 to 36% below its peak, while brokerage firm Edward Jones calculates the average bear market lasts about 15 months. We aren't quite at either point yet. It most likely depends on your personal situation, whether it's safe to invest in the S&P 500 now that it's 25% below its peak. If you will require capital in the near future, there is a risk in being exposed to stocks here. If you're approaching retirement age, the answer becomes even more complicated. Your impending retirement does not necessarily imply that you should sit on the sidelines. While you may begin withdrawing some of your retirement funds right away, the majority of investors' retirement savings will not be tapped until years later. In the meantime, it would be nice to grow that portion of your nest egg. And stocks remain the best long-term growth engine available. Perhaps a better question is, are you more afraid of losing money in the short run, or missing out on a chance to make money in the long run? If your portfolio has a 5-year or longer outlook, the greater risk is not being in the market when things are tough, but not being in the market when things finally improve. Most investors are afraid of the former until they have considered the consequences of the latter. That's all for today, and we'll be sure to catch you all in the next one.